Okay, welcome to Scrushy on Business. Boy, I tell you what, it's great to be back. We got a lot of things to talk about. We've gotten a lot of emails in on the last few shows that we've had. And, I'm Richard Scrushy. I'm excited to be able to bring you this business podcast. We have things that we want to talk about. I had questions. I got some emails. People have been asking me, okay, that's great. You told us how to build a business. You've talked about entrepreneurship. You've talked about the things that you've got to do to form companies. You've talked about how to raise money. You've talked about, companies going out of business and things that they did wrong. We talked about how to, locations and hiring management teams and doing all of these kind of things. But what I want to know, and this happened, we've had a couple of these over the last few weeks, and I'm finally getting around to it. I want to know how to sell my business. I built a business, but I want to sell it, and I want to talk about things that I need to know about positioning my business to sell it. But before I do that, I want to go ahead and we got to talk about Brothers Cleaner. Man, I tell you what, you can go to brotherscleaner.com, brotherscleaner.com, and you can get this multi-purpose cleaner. And I have to tell you, the commercial, because this is our sponsor, it's great on everything. It's a multi-purpose. You use it on your carpet. You can shampoo your carpet with this. I mean, you can take some hot water and put it into your shampooer and then take about, a third or half of this bottle and pour it in there, and it will clean a huge area. So carpet, floors, furniture, windows, countertops, fabrics, cloth, linen, plastics, leather, stainless steel, glass, wood, marble, granite, your vehicles inside and out, anything on your vehicles, it cleans it. It's great on your leather seats, great on your vinyl, great on your carpet, great on your dashboard, your windows. It's better than Windex. It will clean windows and it does not leave a streak. It's fantastic for restaurants, hospitals, any business where you've got big windows, you want this right here. There's nothing that will clean it better than this right here. This is great stuff. It cleans, again, boats, inside and out, RVs, interior, exterior, whatever. This is a great product, has zero smell. I will tell you it's eco-friendly and biodegradable. You can put it in water, it won't hurt the fish, clean your boats. It has a neutral pH, 7.0. And so I actually went to the manufacturing facility. They tested this pH in front of me and showed me that it was 7.0. So I know it's 7.0. It's not toxic. It has no acids or alkalines. It's VOC free and it's earth friendly. You want some of this. It's great for your kitchen. I tell you what, if your wife, gentlemen, ever starts using this or you start using it in your house, pet stains, blood on your shirt, grease on your tie. I had a sport coat. Somehow I got Italian dressing all over it, one of my favorite sport coats. And I couldn't get it off. I tried all kind of things, but then I put this on it. I took a wet rag, let it sit for a little bit because it starts lifting it up out of it, and then I cleaned it, and it was gone. So that's our commercial for today. Brothers Cleaner, go to brotherscleaner.com and get you some of this. They've got a special on right now so that if you buy 4, one of them is free, so you're really only paying for 3. And the one is a 32-ounce with a sprayer. It does stream, and it does spray. $15.99. Can't go wrong. This is a great product. If you ever try it, you'll keep using it, I promise. All right, let's talk about selling your business. Again, we've talked about a lot of things, but we haven't talked about selling your business. But before we do, we're behind, by the way, on answering questions. We have more questions. I hadn't even been able to get to all of them because we went a couple of weeks, so we did not answer any questions, and I apologize for that. People, thank you for the questions, and I will get to your questions. I'm not going to leave any of them out. I mean, we're going to start pushing through every time. So here's what we had. Karen from Nashville. And here's what she says. She says, you said last week that one of the reasons that small startups fail is choosing the wrong team. The wrong founding team are hiring people too fast before it's time. That's exactly what I said. And she said, can you give me some examples? I'm in the process right now of putting my team together, and I want to ensure that I bring on the right people. Well, boy, that's a good question. And that is so important. What happens is we hire people sometimes too fast. We might even hire them before we actually need them. But you need to be job specific. What is it that they're going to be doing? And you want to make sure that they have the abilities. Because if you're in a startup business, are you really going to spend a lot of time teaching everybody you hire how to do their job? Wouldn't you like to have people that actually understand if you're going to hire a marketing person, that marketing person needs to be a good marketing person. If you're going to put somebody in HR, get somebody with HR experience. And, if it's an accountant, get somebody who has, ideally, you'd like to have at least a 2-year accounting degree. Now, there's some bookkeepers out there that are mighty fine folks, and they're great accounts payable clerks, and they do good accounting as well. But I'm telling you, you're going to build a balance sheet. You're going to have P&Ls. You want people that know how to do all that. You want to make sure that you run all of your, pay all of your payroll taxes, and you got somebody that's handling your payroll. And then what's real important is your collections, your receivables. You got to have somebody that does that. So when you start looking at hiring people, you want to make sure they have a skill set to be able to do what you're going to hire, what you're going to ask them to do. But on top of that, you got to get along with these people, because sometimes you're going to put pressure on them. I mean, a lot of times you have deadlines to make, and you're going to be pushing your marketing, your development people, your operations folks to get things done, get it done on a timely basis. And so the question is, when you hire them and you interview them, you need to ask them the questions. What makes you mad? What is? Give me the work environment that you would like to see. I have I had an experience once. I hired a lot of people in my life. We had like 50,000 employees working for us one time. But I had a person tell me one time, and I asked that question, you give me kind of the work environment and kind of what you like and what would be great for you. And they said, I don't like to work weekends, and I don't work holidays. Okay. And I don't work after 5. And, I like to, I come in on time, but, I take my lunch hour, but I like to go home at 5. And I thought, golly, I'm building a company. We're taking a lot of risk here. I work whatever, whenever, however, whatever it takes. I mean, I may be flying back across the country. We're building a national company. I may be in California for dinner, and then I have to be at the office at 8 o'clock in the morning, and I just fly all night so I make it. And I need people around me that are willing to do whatever they have to do to be able to get the job done. I don't need somebody. And what if we do have to work a weekend? I don't like working weekends myself. I try to get it all done during the week. And I used to tell my people, let's work late on Wednesday and Thursday night, and if we have to on Friday, which I really didn't like, but if we have to, we will, because, you got to have your family time. But if you have to work Saturday and Sunday to get a proposal out or to close a deal or to go meet with a client or do whatever, you got to have people that will surround you, especially in a startup business, that'll go do that. So you need to, when you interview them, you need to find out these kind of things. Then I had a guy tell me once he wanted to be in management because it was easier. And I said, what? It's easier? I said, no, it's not easier. Look, when you're managing other people, you're responsible for all those people. So when you interview, you talk and you find out, if those people are really willing to pull the wagon with you, or are they going to ride in the wagon? They're going to pull against the wagon. And if you've got to go uphill with that wagon, you want them to grab a hold of it with you and do whatever it takes. Those are the people you want to hire, especially in a startup company. Now, what we see in, I hate to say it, university settings and big business gets sloppy, and people will work, less, and they're going to be leaving it. They're going to knock you down trying to get out the door at 5 o'clock, and you start to see that. If that culture is that in that company, government jobs, the worst. People are, they make sure that they're not there 1 minute longer than, and if they can sneak out, they will. If they can find a way to do less, to work from home and not be there. Some jobs are okay working from home, some, but I think in a startup business, you need a team around you. I wouldn't let anybody work from home. Personally, I would not in a startup business. You are going to all be there because it's a team. Because see, here's kind of what happens, y'all, in a startup business. Your people need to be versatile. You may have to send that accountant out to do something operational, or you might have to send your operational guy out to do a sales thing. You never know. You don't know in a small company, because what you don't want to do, you want people that are versatile, and you want people that are willing to do whatever they have to do. So answering your question, Karen, the interviewing process is critical, and you got to wrap your arms around those people, and you got to know for a fact that they're going to pull the wagon with you. Now, when you do their background check it good. Check it good. Find out if they were fired from another job, why. You want to know why. If they were fired because they had a falling out with the boss, you probably going to have a falling out with them. If they were fired for stealing, you probably got a thief you've just hired. There are things that you need to know about people. So always do your due diligence. But one of the things that is so important, chemistry. Can you and that person, can y'all pull the wagon together? And will that person have your back? And will they help you achieve the goals? And if you can determine that that is a fact, that's going to be a good employee. And so that's where you go. And then find out where they want to end up in life. What would be the perfect job for you? And if they say, well, perfect job would be one where I only had to work 3 hours a day, that's not a good answer. Perfect job is one where I can make enough money to feed my family, that I enjoy the people I'm working with. I enjoy the company that I'm working with. I've got great leadership that I'm working with. And a place in an environment where the culture is strong and positive and they serve the customers. And I mean, these are things I'd want to hear. And there's a lot more, but I can't spend the whole show on talking about this one question. We got others. Let's go to Terry from Huntsville, Alabama. Terry said, you said there were 3 things, and the biggest things that investors these are the biggest things investors look for. And let's see. And so when the CEO's raising money, he says, one of them was clarity of vision, and another was credibility, clarity of vision, and relentless execution. That is what I said. And he says, I own a service company, and I'm trying to expand. I'm looking for angel investors. Okay, well, he says angel investors, and he said, would these 3 things apply to them as it would apply to venture capitalists or large funds? Well, that's a good question because, it would apply to anyone. I mean, if you're looking at an investor, whether he's an angel investor or a big fund manager, I think, an angel investor might not be as critical as a venture capitalist. I'm saying venture capitalists are, these people are mean. I'm telling you, they don't let up, and they're going to put you through the mill like you have never seen. So you better be ready for it. You got to have your guns loaded. You got to have all the answers, because they start asking you questions that you ought to know, and you don't know them. They're out of there. I've seen it more than a dozen times. I've watched them walk out of the room. I've had companies that have asked me to help them, and I would sit down and tell them, this is what you need to say. And then they get in the meeting and they say stupid things that they shouldn't say, or they didn't have the answers and they didn't respond. And the venture capitalist said, well, I'm not really that interested at the end of the day. So, and then, I'll get back to you. Well, they never got back to them. So yes, number one, okay, I think so. And even if it's an angel investor, I think credibility is important. Now, how are you credible? Well, you're credible by knowing, number one, what it is you're talking about. And by being able to say things like, such and such company does this, and here's how they did it, and this is how successful they were. Now, what we're doing is this, and we're doing it different because we believe that this is a better model. And so you begin to explain things like that, and you become credible. Also, when you're willing to talk about the risk, when you're willing to admit the risk, and you say, yeah, there are 3 risks, or there's a major risk here, but this is how we're going to mitigate it. This is how we're going to overcome it. You begin to build credibility. There's some problems in this industry, but here's how we're going to get around those problems. Now you're building credibility with the investor. So yeah, credibility. Number 2 is clarity of vision. You don't need to stumble and trip over what it is you're going to do. You need to be very clear. I know how to take this to $1 billion company, and here's exactly what the plan is. We're going to do this first, and here's how it goes, and we're going to do this. And I'm here today raising money because we're going to use that money for this and for this and for this and for this, and that's why we are here. So when you start, when you really got clarity, and if they say to you, well, how are you going to use this money? You say, well, I kind of think, we're going to use some of it for sales, and we'll probably use some of it to buy this, and probably use some of it to buy. Well, that's not clarity. That's like you just guessing. Okay, well, let me give you a bunch of money, and you go figure out what you're going to do with it. No. Let me tell you, give it to them. Clarity. We're going to use this much money to buy equipment, and this will build 10 locations. I'm making all this up, right? And we're going to use this much money. I'm going to hire 15 people, and I'm going to have them in sales, and I'm going to locate them in Nashville and Atlanta and Birmingham and Jackson, Mississippi and Miami. Okay, now we're getting places. We're being specific, and we're being clear about what the vision is. Now, why am I locating them in those places? Because each one of those cities, in our calculations, the average age in that city is 45, and average age of our customer is 45. So we're going to major cities. Also, the average income is $150,000 a year for those people, and that's exactly the person we're going after. And here's why. You see what I'm saying? So you begin to get credibility because you're specific, because you know your product, because you know your customer, those kind of things. So yes, that is. And even in an angel investor, yes. And then the third thing was relentless execution. Okay? That's credibility. I mean, that's important. And they're looking for that. They want to know, are you going to, you're the kind of person that would give up? Or are you a fighter? Are you a tiger? Are you going to stay on it? Are you going to make it happen? Those are the questions and that they're looking for. And yes, that's something you got to do. Okay, next question. David from Houston, Texas. When you talked about the 10 most common reasons small startups fail, one of them was flawed business model. Can you talk a little bit more about that? I think I've got a great business, but how do I know whether or not my business is a flawed model? Well, that's another good question. How do you know? You better have checked it out, right? You need to know. Because if in fact it is flawed, then you're going to fail, right? And you're going to lose the investors' money, and you don't want to do that. So how do we know? Well, we ran models, pro formas, right? We tested those pro formas. We've looked at the industry. We did last week I went over that pricing analysis. How do you determine, what the price ought to be? And I actually gave you the formula for doing that and talked to you about what you need to look up on the internet. There are a couple of different approaches to pricing. So you get your pricing right, because let's just say that you had pricing at $100 and it really was only 25. Well, that's flawed, and you're going to fail if you don't get your pricing right. So you got to get your pricing right. And then the other thing is you got to get your expenses right. What's the cost of goods? What is the cost of goods? You got to know what that is. And then you got to know, my employees, how many is it going to take, and what's my rent, and what's this, and what's that. So you got to have all of that laid out and calculated and figured out. And for example, it just like I just said a while ago, if in fact the average age of the person buying your product is 45 or 55 or 65, whatever it is, how many of those people live in that market that you're going into? How many people have to be in the market? And what markets are you looking for? I remember telling the investors when I was beginning to build Health South Corporation, I said, the first places I'm going to go to the top 300 MSAs in America. And those are cities, communities with more than 100,000 people. So the first 300 places I'm going, I'm looking for MSAs, and again, metropolitan statistical areas where there's more than 100,000 people. Why? Because I knew that I would be successful. Because in a market like that, I've got good doctors. There's plenty of patients there to be able to fill one of the facilities that I was building. So that was my model, and that's what I told them. That's what we're going to do. So those are our questions for today. Now let's talk. And so David from Houston, check it out. Go through all of the different things to make sure that what you're building is needed. Remember, we talked about that. Make sure that it's needed. Make sure that your product is needed, whatever that is, and that there are people that are going to buy it. And then, I'll tell you what. Also, a really good thing to do is to ask, answer this question. Give me 10 people that that will buy it. 10 right now that will buy whatever it is you're selling, whatever it is your company does. And if you can come up with 10 real quick, you probably got a product that'll sell. And remember, whatever it is you're doing, you need something that's 10 times better than anybody that's trying to do the same thing you're doing, because you've got to be able to build have an advantage over them, right? So that's real important. So, we want to talk a little bit about selling your business today. I want to start that. There are things that people need to know. And the key things on when you're selling a business that we're going to talk about here, okay, valuation methods. How do I determine what it's worth? I don't want to sell it for less than what it's worth, and I don't want to overprice it and not be able to sell it. And then we want to talk about deal structures. Now, we might not be able to do all this in the timing that we have today. We may have to talk a little more next week. And then are you going to use a broker? Now, most businesses that are less than 5 million will use a broker. They will. And why a broker? Because a broker will help you format everything. They will also get on the phone and call people that are potential buyers of your business and help you find somebody. And you're going to pay them a fee, and that fee could be anywhere from, depending on your deal, 2% to 5% of whatever you sell your business for. So it just depends, and you can negotiate that with that broker. And then one thing you need to do is you need some tax planning, because you don't want to get caught with a bunch of taxes because you didn't structure the deal right. And depending on how it's structured is going to determine what the tax situation is going to look like. So key steps are going to be, number one, get your finances in order, the financials in order. They're going to come through. You've got to give them a book, or nowadays what people do is they have a room. They call it a room, and they'll load up a room on the internet with all kinds of data, everything about your business, all your financials, your balance sheets, everything that's going on, tax returns. They'll put how many employees, what your average pay is. I mean, all kind of different things. Bank accounts. They even put bank accounts in some cases, every bank account for the last year or 2 years or whatever. So you build this room, or you can put it in a book and give them the book, either one. But right now, because everybody uses their computer and it's all digital, typically what they do is they just simply put it in a room, and you can go to it. So, but you got to have at least, I'm going to tell you, they're going to want 3 years of clean financials. They're going to want 3 years. And if you haven't been in business 3 years, well, you don't have 3 years. And let me tell you that if you have audited, it's a home run. Auditing small businesses is very, it's expensive, and people typically don't do it. And most of your buyers understand that. But there's also a thing called a review, and you can get an auditing firm, a CPA firm, to do what's called a review, just to make sure that it's somebody's looked at it to say that it's an audit is clear. Then an audit says it's what it is. A review says they looked at it and didn't find any discrepancies. And so it's cheaper to do a review. A review will go a long way. No review is not as good. Now, if you're a small company, and let's say you're only $1 million a year, or $500,000 a year, or just $300,000 or whatever, you may not need a review. You might not even need anything. It might be simple enough to where a buyer can look at that and they can say, okay, I got it. I see what you sold. I see what your expenses were, your payroll and all that. I got it. Your rent, whatever. So what will kill a sale in a heartbeat is not having tax returns and not having your financial statements in order and a balance sheet that's accurate. Any cash flow records, bookkeeping. If it's messy, you look and you want to sell your business, hire an accountant. Hire an accountant to clean up your books, put everything in order, and then build you a room or put it in what we call a book that you can hand to a potential buyer and they can go through and see everything. Small business, your book is fine. When you start looking at big businesses where they've got massive accounting, massive bank accounts, customers, lots of employees, all of that, you probably just do a digital room and then give them access to that based on signing an NDA. Now keep that in mind. You want a non-disclosure agreement. You want it signed. Because what you don't want is for them to take your information and go over here and give it to a competitor. And if you find out they did that, you got a lawsuit. They signed that NDA. That's private stuff. And that's important because there are people in the world that would come get your stuff and go use it against you, maybe give it to somebody else and do that. So you gotta watch that. So, all right, next. You got to know what your business, so you got to have all that together. And if you don't have that together, you are not going to sell your business. So once you get all that organized, you got it together. The next thing you're going to do is valuation, right? What am I going to sell this for? And there's several ways that you can sell it. Number one, you got assets. It may be that it's an asset purchase, and you say, I bought all this equipment, and I've got all this, I built all this, and whatever you're selling. And they can look at it, and they could do an asset purchase. They could buy it, and then your receivables. Now you may have receivables. That's an asset. So you may have somebody that would buy the business based on just assets, and they would look at that, and you could have them all listed out, and then sell it for that, and put some kind of premium on it since you put it all together. But that's one way. Another way is a multiple of EBITDA, earnings before interest, taxes, depreciation, and amortization. And that is a very common thing. And why is that? Why do people do that? A multiple of EBITDA. And I'll tell you why. Keep in mind, and we've talked about this in the past, publicly held companies trade, they have what's called, and when you look it up, a PE, price to earnings ratio. And that's a multiple. In every industry, in every company that's public has a PE ratio. And that's the price of the stock versus the earnings. And so public companies will trade, successful public companies will trade, something north of 8, 10, 12, 15 times earnings. You'll see a PE ratio. Some businesses like the AI business might trade at 100 times earnings. I mean, they might not have any earnings, so it might be an infinite deal. But some of the new biological companies, pharmaceutical companies, they trade at incredible PEs, okay? But when you get down to companies that have earnings and have revenues and earnings and have profits, they're going to trade at a multiple. And I used to I taught a course once on this, and what I did was I broke out all the industries. I broke out the hotel industry. I broke out the airplane industry. I broke out banks and healthcare companies and all these different companies. And I had students look at the different PEs on all of them. And so they began to look at them. And they said, well, wait a minute. They said, yeah, so there's kind of an average PE for airline. There's kind of average PE for hotels. There's one for restaurants. There's one for hospitals. There's one for different kinds of healthcare industries, different kinds of businesses, and banks. And I mean, I could name a whole bunch of businesses. And yeah, they're different PEs. Now, why are the PEs different? Well, they're different because those industries have different growth rates. Okay, the higher growth rate, guess what? The higher the PE, because Wall Street will pay for that growth rate. If you're growing a company at 20 times, you're probably going to find a PE ratio, a price to earnings ratio of about 20 times. I see it all the time. So if you look up a company and say, what is their growth rate? And it says, well, it's 25% a year. Go look up and see what the PE is. It's going to be close to that, if not dead on it. Okay. Now, if an analyst on Wall Street comes out and says that company's going to grow 30% next year, guess what? PE is going to go up now because it's not growing anymore at 25%. It's growing at 30 times. So next year is going to be so what happens is it's going to go up. So that's what drives it: growth rate, profitability, and then track record. Hitting it. See, companies trade on future earnings. So when they when a company comes out and says, I'm going to earn $1 million next year in profit, and that company it'll trade over that, say they're trading it, and that growth rate was 20%. So they would say, okay, the company's going to grow 20%, going to earn $1 million. Well, guess what? It's going to now trade at that new valuation, which would be 20 million, And so depending on how many shares you got, if you had 20 million shares, it'd be $1 a share, wouldn't it? I'm just making these numbers simple so you can understand the math in it. So when you start looking at what your business is worth, you got to look at what industry you're in. So the industry you're in, if you go to the public markets, you'll find that they're trading at some average amount. But now let me tell you something. If one of those airlines, and we're looking at just airlines and what all their PEs are, and if one of those had a bad quarter, guess what happens? PE goes down because they're going to change the trajectory of their earnings. So the analysts are going to come out and say, well, they're not going to earn quite as much the next year because they had a bad quarter, because this happened or that happened, or they had a hiccup and management screwed up something. So they missed their earnings. Their costs went up too much. So you're going to see PEs come down. But if you take whatever industry you're in and you find out kind of what it is that they trade at. Now, if you're a private company, you're not going to be able to sell your company at the same PE that a public company will trade at. It's just not going to happen, because in the private market, there's at least a 30 to 40% discount off of that. So if your industry is trading at 15 times, okay, the chances of you selling your business at 15 times on whatever the public is trading, the public company trades at, it ain't going to happen. You're probably going to look at something along the lines of 6, 7, or 8 times, because that is kind of where it is. But if a public company is going to buy your business and they're trading at 15 times and they can buy your business at 8 or 9 times, it's going to be what we call accretive. It's going to be additive to their earnings per share, and very additive, because they're trading at 15 times their current earnings per share. They bought your company at 7 times, 8 times earnings, okay? But the public market is going to pay them 15 times of those earnings. So what happens to the stock price? Whatever their earnings are on your company that they have acquired, their stock price is going to go up accordingly. It's just going to take that earnings, multiply it times 15, okay, and they're going to add that to the valuation, and you're going to see the stock price included. And that's what the markets do. So when the analyst comes out, he'll say, and when he looks at the acquisition that the public company is making of your company, he's going to go out and say that the stock ought to go up to this amount based on the earnings of the company that the public company is buying and based on where they're trading. Now, here's the good news. When they acquire that company and it's so accretive, their growth rate increases. So that's going to have an impact also on the multiple and the price to earnings ratio. So the shareholders are going to make out very, very well on that. So that's why companies that are public companies look to make really good accretive acquisitions. So if you've got a private company and it's in an industry where there are multiple public companies, the chances are you can probably sell that to one of those public companies. Now, at a good price, because they can pay more than an individual will pay, because an individual may try to buy your business for 3 times or 4 times, okay? And if you don't have a public market that is interested in whatever it is you're selling, you may not be able to get more than 3 or 4 times whatever your earnings are. That may be the most you can get, or it might not even be that much. It might be 2 times. I've seen that. And then some people end up just 1 time's revenue, or they just do an asset sale and sell the assets. So I had a company come to me one time, and they said, we want to, had a CEO came to me actually, and he said, I've had an offer for my company. And I said, yeah. And I'm going to kind of make these numbers up, okay, because I don't remember exactly, but this is pretty dang close. And he said, they've offered me $13 million for my company. And he said, would you look at it and tell me what you think it's worth? And I said, yeah, I'll be glad to do that. So he gave me his financials, 2-3 years financials. I looked at them and I said, your company's worth $27 million, at least 27, 26. And I said, 13 million is cheap. He said, you really think that I can get that much for my company? And I said, absolutely. I mean, that's what it's worth. I said, look at the public companies. And this guy was in the healthcare business, and there were a lot of public companies that were in the same business he was in. And when I looked them up, I said, look at what they're trading at. These companies are trading at 20, 22, 23 times earnings, and you're over here selling your company for that based on your earnings. And when I looked at what the public companies could pay, and I said, if they just paid 10, 11, 12 times, and they're trading at 22, if we can get them to that, your company's worth 26 million, because they were offering him like six times or something like that. And he said, can I hire you to sell my company? And I said, well, yeah, sure. I mean, I'll help you sell it. Well, who's this buyer? And he told me who the buyer was, and it was $1 billion company up in New England. And I said, well, just give me the information. So I called the CEO of the company, and I said, you want to buy this company? And he said, yeah. Matter of fact, they needed it because they needed to increase their earnings, and they had a growth rate they were trying to hit. And I said, well, you have to deal with me now because I'm representing this company. This was a long time ago, y'all. This was years and years ago. But I said, I called the guy up, and he knew who I was because I'd been running a multi-billion-dollar company. And he said, so I got to deal with you? And I said, yeah. He said, well, I will fly to wherever you are tomorrow and let's have lunch. And that CEO of that $1 billion company, he flew to where I was, and we had lunch. And he said, we made an offer of $13 million. He said, I feel like that's a good price. I said, that's not a good price at all. And then they're not going to sell it for $13 million. I said, I've looked at your earnings. I've looked at your PE ratio. I know what you're trading at. and I know what you can pay, and it still be accretive. And he said, well, what are you asking for? And I said, well, I can tell you right now, it's 27.5 and 27.5 million. And he said, no way, we're not pay that. He said, I'll give you, and look, listen to this. He went from 13 million to 16. He said, I'll give you 16 million. And I said, no, it ain't going to happen. I'm telling you. Well, we're having lunch. Went ahead and ordered lunch. I think he had a glass of wine, and by then I probably had one with him because we're in deep negotiations. And then about that time, before we finished, he said, I give you $21 million. Now, just think about this. We were at 13. Now I've got him at 21. And I said, no, it's 27.5. That's the price. And I said, then let me tell you why. Because when you buy this, here's what the street's going to do. Your stock price is going to go up because, look, this is so accretive. Even at 27.5, it's extremely accretive to you. And I'm giving you a great price. And he finally said, I'll give you 26 million. Now, 26 million was double what he had offered the guy. And they really put a sales job on him. And the guy would have sold it had I not came in. And I said, look, I'll tell you what, we'll take the 26 million, but I want that other $1.5 million in an earnout. He said, what do you mean? I said, if we hit the numbers, you owe me. If we hit the numbers that we have projected, you will pay that other $1.5 million. He said, you got a deal. And we shook hands. So we left there. I called up the owner of the business, the CEO of the company, and I said, 26 million, I got you double what you had before, and you got $1.5 million earnout. And that deal went through, folks, and that happened. But I had to negotiate with the guy, and I didn't give you all the details of it, okay, because there's a lot of back and forth. But that's the basic deal. We have to know what your business is worth, and that's what I'm talking about. How do you know? Well, you got to look at the industry that you're in. You got to figure out what are these things selling for? What are they trading at on the public market? You can't get that, but you know what? You can at least you know where it's at here, and you know what a public company can pay for it. But now it's totally different when you're dealing with a guy that wants to buy, or a family that wants to buy your business, and say you got a restaurant that did $250,000 last year, and they want to buy it. So how do they value it? Well, you still got to look at some kind of return on your business, and if you've got $200,000 worth of kitchen equipment in it, you definitely got to get that money out of there. And if it's making $250,000 a year, that has some value, and at least you ought to get a multiple off of that. And I would say that business, you want to get as much as you can from them, and I doubt you're going to be able to get $1.5 million. I doubt you're going to be able to get $1.2 million, but you probably can get somewhere in the neighborhood of somewhere between 600 and 700, all the way up to maybe 800 or 900,000, maybe $1 million. I don't know. It depends on the business and your customer base and the ability for them to expand. Now, a lot of times when somebody's buying a business, they come in and they look at it and they want to know, can they add value and increase the profitability of that business, increase the sales or the revenues and the profits. And a lot of times they'll say they know they can. So if they buy that business based off of a 3 or 4 multiple, off of what you're currently doing in terms of profits, okay, and they know they can add another $100,000, $200,000 by adding different things that you're currently not doing, and they can buy it from you off of what they're doing now, and they know that they can increase that, then that becomes a really good deal for them. So valuation. Now, there are people that are advisors that will come in and tell you what they think your business is worth. But keep in mind, too, you got to look at the trajectory. So, if you started down here and you're doing $100,000 a year, now you're doing $200,000, you're doing $300,000, and now you show them it'll do $400,000, then you can sell it to them and get a little piece of what it's projected to do. Now, if you're good at what you're doing. I've seen that happen, and I've seen we ain't paying for nothing that we do. A lot of times they'll say, yeah, but that's only going to hit that number if we do what has to be done. I'm not going to pay you for what we have to go do. So they may try to hold you to just what you've accomplished over that 3-year trajectory, okay? So those are things that you got to think about, and you got to come up with, what is it really worth and what can it generate? Because what you don't want to do is sell it to them for something that they never get a return. That's a problem. Now, here's something that will also have an influence on pricing of that business. Interest rates. Let's say that they put some money up front, and the rest of it they finance. And let's say the bank is charging them 10 or 11%. Well, you have to build into that. Okay, what does that mean to the profitability of the business now? Because once you add 10 or 11% interest, okay, that's going to cut into the profitability of the business. So they've got to get some kind of decent return, and you actually can run the numbers and figure the return out. But you're going to have to build in, if they're going to use some financing to do it, then you got to put in the financing cost and help them understand. And then you understand, because they can't buy the business and be in the red. They need to buy the business and have profits coming in. Okay, so if they have to finance it, you got to build in the financing costs. Okay, next, your team. You got to, your team's going to be important. So, it's always a problem, isn't it? The psychology of you now selling the business and the team now is like, oh gosh, there's somebody else, we're going to be working for somebody else, and how's that going to work? And all the problems associated with that. So everybody starts worrying, do I need to go look for a new job? Are they going to come in and cut the team back? Are they going to fire all of us? And those are problems, and those are issues, and those are real things that you got to think about. So you're going to have to deal with your people and getting them into a situation when you bring a person through that's looking to buy your business. The first time you bring them through, most people don't tell the truth. They'll say, this is a friend of mine or a business associate or somebody that I wanted to share with them what we're doing. Because you don't need to go shake the whole team up and say, I'm selling the business, until you know you got somebody that wants to buy it. So when they're just, kicking the tires and going through the business, you what you don't want to do is scare the heck out of your team, and then they get non-productive because they spend all the time talking about what's fixing to go down, am I going to lose my job? So you got to be careful with all of that. But you do have to put assemble a team to sell the business, like, your accountant, and you have to have an attorney to do the transaction. Those are all important things. So you got to have that together. You may have to have a broker. If it's a big business, you may have an M&A advisor, and you can use your investment banker to do that. But so anything that's $5 million or under, you usually do a broker or use your CPA and your attorney to work with you. But when you start getting into big companies that are 10 and 15 and 20 and 30 million and more, you're going to have to use an investment banking firm to do that. Now, there are small banking firms that are boutiques that do small transactions that are 5 and 10 and 15 and $20 million transactions. So you can hire one of those firms, and that's the best thing to do. Because what they do, they go sit down with the other people, and they get all the questions, and they go over everything with them, and they help you get the deal done. And you got to pay them a fee, and then, again, it's 2 to 5%, depending on the size of your business. The bigger it is, the less the percent. Okay, that's kind of how that works. Now, that the buyers are going to dig into everything you've got. They're going to look under every piece of furniture. They're going to want to talk to employees at some point. They're going to look at every agreement you have, every contract, every lease, any employment agreements. They're going to look at intellectual property, any pending litigation, any customer disputes, or, even customer concentration, where you might have a whole bunch of customers that if you lose any one of them, they could cause some issues. They're going to look at all your vendor relationships, and they're going to look at regulatory compliance is huge, especially in healthcare. So what do you do about that? Well, you organize all of it into the data room so that's already there. All of these things are there so that it's easy, because if they start asking you for it, it looks like you're trying to hide it, and you don't want to hide it. You want to give it to them. You want to have it for them. Make it easy. So you got to prepare yourself for due diligence, right? And then you got to be thinking, if you're going to sell your business, you need to be thinking, how do I reduce if you're out, if you want to sell it and you don't want to have anything to do with it, you got to start thinking about, how do I reduce the need for me to be there? That's an issue, isn't it? Because if they come in and they figure out that without you, it's not worth but half of what you're telling them it's worth. So you gotta prepare to make sure that your business can run without you if you don't want to be there when you sell it. Now, if you're going to be there, you can enter into an agreement with them that says, I'm going to be here for 3 years or 5 years, or, I'm going to hang around and I'm going to help you and I'll become an employee and whatnot. So those are things you got to think about. Do you reduce your involvement if you're going to be leaving? You go ahead and start putting other people promoted so that when they come in, they can see that they don't need you to run this business. Because if they just decide that the business goes away or fails without you, then chances are you're not going anywhere because they're not going to buy it unless you stay there and help them. So you want to make sure, too, that you structure the deal in a way that is advantageous to you from a tax standpoint. So you got to be careful about that. And so however you do it. Now, you may be an LLC, you might be an S Corp, you might be a C Corp. So all of those things, you need an advisor. You need a tax advisor that will tell you, based on your personal situation, the best way to structure this deal for tax reasons. So those are some of the things that you want to think about, when you're thinking about selling your business. And you also want to be emotionally prepared for what's getting ready to happen here. So many times people think they want to sell their business and then they don't. I got involved in helping a friend of mine wanted to buy a company, and he asked me would I help him. And so, I'm a retired guy, right, doing a podcast. I said, yeah, sure, I'll go with you. So I went and looked at the business with him. And I met with the people that owned it, and they seemed like they wanted to sell it. And we talked about pricing and kind of what they wanted and everything, and this drug out for about 6 months, and I thought they had agreed to the pricing and how everything was going to go down, and it seemed all really well. And then at the last minute, they pulled the deal. The seller pulled the deal and said, we decided not to sell it. There's not enough money. And I said, wait a minute. Y'all had agreed to this, and all of this was done, and all the due diligence was done, and now you are saying you don't want to do it. Well, you wanted to do it before, and it all seemed fine. Well, the bottom line was it didn't have anything to do with pricing. They were having, some psychological seller's remorse, and they pulled the deal and made up a bunch of excuses. So when a deal is, my analysis of that deal was the buyer waited too dang long to close the deal because they kept doing due diligence and due diligence and due diligence and due diligence. And I was like, stop doing due diligence. We got to know this, and we want to meet this and go here and there and all this and visit and go through this and that. And if they had just gone out there, gathered all the information, and we had it, and make a decision, that they would have sold it to them. And it would have been a great acquisition. So really thinking through things, let's just review it real quick. Get your finances in order, make sure all the financial stuff is there, and either do a book or set up a room. You got to know what your business is worth, so you got to value it. You got to assemble your team, and your team to sell it, which is your accountant, your lawyer, whether or not you have a business broker or whether you're dealing with an investment banker or whatever. So that's that. And then you got to assemble your team that is inside to make sure that, everything is like it ought to be when they come through there and start looking at the business and how it's doing and the culture within the, that's all also very important, the culture. So you want to also make sure that all of that is set up just right. And the way that you do that is to plan, organize, and really think through what you're doing because you got to make it right. Okay, that's important. And then we want to talk about the due diligence. You want to be prepared for that. You want to make sure that everything is there, all your contracts, all your leases, everything has to be in that safe room or in that room, that data room that they're going to be looking at, employee agreements, intellectual property, all kinds of different things like that. So that's why, we do this podcast because it's very important, and we want people to be able to learn things from the podcast. And so we talked about that. Also, we're dealing with your involvement. My phone's ringing off the hook today, so I'll catch up with those people later. But the bottom line is reduce your involvement if you're not going to be around, okay? And then the deal structure. You want to work on that. So those are the things that we want to make sure that everybody's focused on, and they understand that. We can talk more about that. There are other things that we can talk about relative to selling your business, but I've got to end it. Remember, this is our sponsor, Brothers Cleaner, and it is a great cleaner. And if you don't have any of this, you need to get it. We got a special coming up soon. I'm not going to tell you what it is, but I will in the next podcast. You're going to want some of this. And I promise you, once you start using it, you won't ever use anything else. Throw all that other stuff away. Buy this. I promise you'll be happier. Y'all have a great week, a great evening, and I will talk to you next week. Scrushy on Business. Make sure you subscribe. Absolutely. Go on, hit that button and subscribe. That way you'll be notified every time we put up a new podcast, new episode. Thanks again. You have a great day.